Greetings, welcome to episode 9 of Optimum Live. This one's quite a beefy one, this one. We're really going to get into something interesting that when the guys brought this one up, it resonated me as a business owner, as a solopreneur, to limited company, all of those things, with so much changing around our country at the moment, some of which might not even make it into this show because they're just changing at the moment, as we know. But the good news is the guys that put the pressure on me for this to be the content of the show, they're with me as well for this one. So I'm going to introduce the full group that's here. We've got Mike Blaken and Rob Stokes. Greetings, gents. Right. Yeah, afternoon. Yeah, I was trying to remember, is it morning or afternoon? It's afternoon now. Good afternoon, sirs.
Good afternoon.
This is the first time that you've done it face to face, isn't it, this show?
It is, yeah. Well, previous time was at Christmas, yeah, and I was in the office with my silly hat and jumper.
And I do, yeah, I was going to say with a pint, that was your idea, wasn't it? It was like, it was the Christmas celebration, and you asked me yesterday, can I have a can again?
Yeah.
No, Rob, no, not
it's
this
a stressful topic, so I might need it.
It really is. I mean, in a synopsis, Mike, before we get into each point in a bit more detail, it was, I'm going to throw you under the bus here. It was your idea, is the fact that there's a lot of things are changing that gives food for thought. But what was your real, motivation for this subject? The future of the limited company.
There's a lot more questions being asked from clients saying, should I still be a limited company? Is it still working? The big drive before was saving some tax. It's not as much. Tax rates have gone up heavily. Anyone who's got a limited company should have realised by now that they're paying a lot more in tax. So it's more of, is it right? Is it fit for purpose now? Is it doing what you need it to? Because the tax savings that might have been the driver before isn't now. And it kind of picks up on the business plan before. Is what you're doing still right for what you set out to do?
Thankfully, we're going to break that into a whole load of different bits and pieces as we go. And for everybody watching, if you've got questions, please, if you're watching on YouTube, Facebook, LinkedIn, put the questions in, because they will pop up, it's easy for me to say, on my monitor here. And I'll be able to put them up on the screen, and we can ask the questions and answer the questions live, hopefully, is the plan. First one, I mean, I've possibly put this as too generic a statement then. Is LLP becoming more attractive than limited? First question then, which of you should I put this to? Explain an LLP.
Yeah, absolutely. That was the first point, I think, is let's set the scene in terms of limited company. Quite often, it's just one individual who's got a business, And apart from the tax advantages that Mike's talked about, there's the limitation of liability. So things go wrong, it's its own legal entity. That's primarily what's at risk.
Okay.
LLP is kind of a stepping stone from partnerships up to a limited company. So an LLP is at least 2 members, hence the partnership element to it. You get the limited liability wrapper, but it's not as all-encompassing as the limited company. So for an LLP, if you've not withdrawn all of the profits, whatever's sitting in there is effectively the owner's earnings.
Okay.
That's at risk because it's still in the entity.
Right.
So it does offer the limitation of liability. It's not as encompassing as the legal limitation in a company.
Because people like yourselves, I mean, are you guys an LLP?
No.
No. I was about to say quite often that you see solicitors and things like that will be an LLP.
It is something. I think the stats are around 80-90% of LLPs are professional service firms.
Yeah.
And I think a lot of that is around the fact that historically they would have been partnerships, but the limitation of liability wrapper has been gone. Okay, accountants, solicitors quite often get sued by clients if something goes wrong, like particularly, I don't know, in the conveyancing chain, something goes wrong and something has been missed, they get sued. As an ordinary partnership, you're at risk yourselves, individuals, whereas the LLP puts that limitation of liability on there. So it's a kind of a no-brainer for a lot of partnerships in professional services, particularly to transition that way.
Please tell me to move on if needs be, but I'm going to raise the question then. Why are you guys limited rather than LLP? Or do you not know? Does it go back too far?
It was set up
Was it?
when we joined, it was that way.
Oh, okay.
But I suspect a lot of that was to do with simplifying shareholdings, that kind of stuff, making it really simple for all of the members to go, right, this is what our earnings are going to be.
I think from a new viewpoint, the simplicity is easy. It's more simple in a limited company than an LLP. The structure is just slightly different.
Yeah.
There's a little bit more to it. So it's a lot more straightforward than a limited company.
Okay.
And so once I think, like you said, when you got the ones transitioning from before, naturally it rolls into an LLP when they come from a traditional partnership. But when you start from a clean break, most people now jump into a limited company. That's been the way, the general move. I had someone for the first time say about LLP back a couple of weeks ago, and he was expecting everyone had done an LLP because it all seemed like a limited company was this big thing that was very complicated and very technical. And I explained actually that there's a handful of clients we got that are LLPs, and the majority are limited companies. It was, for him, it was quite eye-opening.
Oh wow. Okay.
I think for us as well, bearing in mind that we're legal and accounting and audit, we've got a variety of regulators as well. So we've got a group structure, and it's a lot simpler to do the group structure as well with a limited company to enable our regulators to be approving of us.
Got you. No, I get. Yeah, that makes sense. I mean, it isn't a straightforward thing, and what I suggest is a key comment to make is that if anybody is trying to decide. I was about to say setting something up and they're trying to decide which way to go, come and speak to you and know that there's a conversation there to be had. But equally, if there is I guess it's a question, first of all, can you change from a limited to an LLP?
Yeah, you can do. It's not a simple process, but there is a mechanism with Companies House for undertaking that exercise.
Okay, and we're about to get deeper into this about why anybody would even consider it. So that's where we start getting meaty into this. You made a comment that said would need at least 2 partners. Yep. So if I take an example, is that my own limited company is we've got myself and my wife directors of it, then we would turn around and be the 2 partners in the LLP.
Yes and no, because it's effectively the members of a partnership are the shareholders of a limited company.
Yeah.
Not necessarily, because not all directors are shareholders and vice versa.
Yep.
So, but if you and your wife are both directors and shareholders, then yes, you would become the members of a LLP.
And that's an important bit with a limited company is people don't realise the difference. So as someone who operates through a limited company for yourself, you got two hats on. The first hat you have on, you're a director of the company, you're an employee, you're in charge of running the business in the best interest of the people who own it. One hat off, next one hat on, you're a shareholder, you own the business.
Right.
Okay, and that's your two roles that you've got of a limited company. But people put the two kind of replace each other in the way they talk. They don't realise there's a difference. So, for example, like you have a lot of directors of the big PLC companies, but they're not necessarily all shareholders. They're employees in charge of running the business for the thousands of owners of the business in those PLCs. And it's no different to a limited company. It's just on a much smaller scale.
Yeah.
And naturally, you have both. We have both. We're both people. And you don't tend to make a big thing of distinguishing from difference. And that's why for a limited company, you get a small salary, because that's your director's salary for an employee. That gets your that's your tax advantage and your stamp for state pension, which we'll come on to later. And then this top up is your dividends, which is your return on.
So you don't get that if it's an LLP?
No, you just get a profit share.
Yeah. So when you're kind of talking tax and earnings, an LLP is supposed to be, it's known as a tax transparent entity, because each year there's taxable profits, and those taxable profits are split according to the partnership agreement and taxable in full on each of the partners.
Right.
According to your split. So, for example, you and your wife, if it was 60-40 in favour of your wife, she would have the 60% tax charge, would be her personally, and you would end up with the 40%.
Right.
And that's whether you spend it or take it out of the business or not, you get charged. So as a partnership, you get taxed. Same as a sole trader, you get taxed on how much money you make that year, whether you spent it or not. So this is where with a sole trader and partnerships, so an LLP, your income can be going like this. If you have one good year, one bad, rather than with a limited company, whilst you pay a straight tax on the corporation tax, what you take out, we can smooth it out through dividends. And that's what our job is to do, is to make sure that your personal tax has been controlled. But you can't do that so much in an LLP, because you just get taxed regardless of what you made.
Got it.
So whether 1 year you have 100 grand earnings and next year you have 10, you paid higher rate in 1 year and lower rate in the next year, but we haven't smoothed it out.
I think one of the key things I'm going to jump in with now is that we're trying to we need to make sure we don't take this into a full lesson on NLP, because we're going to go down a million rabbit holes there, aren't we? And I guess what is a key thing in these short videos, well, too short for this kind of depth, I guess, is know that there's a conversation there to be had. I know we're going to go into it deeper, but is there a simple thing that would be a trigger to someone that says, if this is the case, or if this happens, come to us and have that conversation?
So there tend to be with a limited company, if they're looking at which one. So if they're going to take all the money out of the business, like all the time, if you make 100 grand, you're going to take 100 grand. If you take 10, you're going to take 10. That tends to go towards a partnership, because you're just getting taxed in full, because you got the two taxes with a company and personal tax. If a limited company, you're going to make more than you take, then a limited company's benefit. But also, if you've got the future that you're thinking of selling it, it's easier to sell a limited company shares than you are to sell your stake in a partnership.
Right.
So it tends to be, that's why the flexibility is a little bit easier with a limited company, even though people think it's big, complex situation. Actually, it's more.
It's a train on tracks, basically. Isn't it?
And because it's our bread and butter stuff, and that technical bit that if you Google it, what's a limited company, you get scared of everything that's on there. That's what we deal with. We deal with that stress and understanding of it, and making sure you're in the right direction.
Okay.
For me, it is about that long-term thinking. What are you aiming to achieve by setting up your business? Is it something that you're just going to keep running? It's effectively your lifestyle business, and it's just there to provide you with an income up to your time that you want to hang up the tools, so to speak. Or are you actually intending building something that you want to then transition onto somebody?
Okay. And an LLP, this is going to be a really stupid question, but I'm good at these, is an LLP, as well as the partners, it still has employees as well?
Yep.
Yeah. So
everything else will be the same. VAT rules are the same. Employee rules are all the same. Everything's exactly the same.
Okay. I'm going to just pause for 1 second, because we did have not that you'd have known, other than Tom, the amazing Tom, who you will meet on one of my shows soon. That's my video editor and producer, sorry, him running over. Did that stop again, Tom? Did the camera stop?
No.
No, that's all right then.
I was just in the shop.
You had me worried. You had me worried because if that was the case, we should have put the mic on that one, but that's fine. I'm not going to do it. If you see me scoot off people, we're proving it's live. Aren't we? We're proving it's live. It's fine. Yeah, edit this out. Edit this out. No.
What's interesting in all of this is Chris is more nervous than we are.
Yeah, only because I saw him move and I'm like, don't, because that's your audio. So that's the other thing. If we lose it, that audio's got to go on there. Right, sorted. Okay, so we've blown our minds with the LLP and limited, and we probably still haven't answered that in full. Oh, okay, we've got a question here. Kev Barker, thanks Kev for tripping in. What about pension contributions between LLP and limited?
So as a limited company, they go out. Hi, Kev, by the way. It's one of my clients. So with pension contribution, a limited company goes out as an expense as a company. So if you got your profit, pension contribution comes off, and then you times that by your corporation tax.
Okay.
But as an LLP, they go more as a personal contribution. Okay, so they go in after your profits. So you get your profits, you get taxed on, but you make your contribution up to your pension fund. They claim the extra tax relief from the government that way. So instead of in the company, you save the tax as an expense. So your profit comes down. This one, it goes in and HMRC top it up. And then if you're a higher rate taxpayer, then you've got, at the moment, the rules are you've got the adjustment on your tax return that you can increase your basic rate band.
Okay.
So you can get them to end up with a very, very similar result, but they do go two different ways, whether you get tax saved at source in the company or whether you get the tax added in your pension fund from the government.
So there's no disadvantage or advantage from one way or the other with that.
So the disadvantage would be that if your profits dropped, there's a cap of how much you can put in as your pension through as a personal contribution, whereas as a company contribution, it's not you as an individual making the contribution, it's the company making it on your behalf. Yeah. So therefore, there isn't the same sort of caps on that. So if you suddenly drop to like no earnings 1 year, then there's a limit of how much pension money you can put in.
Got you. Okay.
And that's
obviously speak to your financial advisor. Because we're talking pension advice, but in principle, Mike's right. Yeah, they both end up as a similar amount going in. It's just a different mechanism for the tax saving and recovery.
Yeah, absolutely. And that's a very valid point on the pension side of things. Yes, we are not advising in the show. Okay, they are not advising. The letter of the law is being kept here. Okay, so we've sort of touched on and blown our minds on that there is a difference between the two. Is there a direction you wanted to take this now, or do we follow this?
Well, one that's
because you know this better than
me.
me.
So there's one that puts the favour back in an LLP. Okay. Which is one that's quite interesting. That would be more on Rob's side of things. Of thinking is depending on what car you drive. So limited company, if you put your diesel, your nice fun cars through, right, you're going to pay a lot of tax and not save very much. Okay, under the benefit in kind rule. That's why the electric cars are a big drive. We spoke about it before. Electric cars and limited company work wonders, right? Because it saves a load of tax and everything like that. But it's different for an LLP, okay? Because you don't get the benefit in kind because you're not an employee, okay? So you put through the percentage of your car that you use for business. So if you put a car through and it costs you 20 grand of running costs, you use it 80% for the business, 80% of the costs go through, right? Okay. Regardless what that car is.
Oh, right.
Okay, so if you've got people who want to drive...
For now.
Yeah. But if you want someone who wants to put their Ferrari through, then actually there's a good chance that running it through an LLP might be more tax efficient in the big picture. So it's another one of those variables that you've got to take into consideration of what, but again, it has to be two people. So husband, wife, two business partners, something like that, to have it in an LLP. But that's where something that the needle, when you're trying to work out which way it goes, if you've got a car that you want to run through and it's not electric or hybrid, the LLP will have a tick in the box.
Okay, so
you weren't expecting that one.
I was not. I have no notes on that one. That's an amazing car. Okay, duly noted. And I mean, is that sort of more the case more recently, because of course the company car thing has become less favourable more recently.
Yeah, absolutely. Again, I think that's another reason that a lot of professional firms went straight away to LLPs, because as a partnership, they always used to run their cars.
Yeah.
So it was effectively paid by all the expenses paid by the partnership or the LLP, and then just as Mike said, the appropriate business percentage was allowed in the comp. So it's just an easy way of doing it.
Okay.
And to avoid the benefit in kind charge, because obviously for a number of years now it's been horrific.
Without meaning to get too granular on a particular subject here, is that the company pays that, or that you claim it back if it's in the LLP?
It's entirely up to how you want to run your partnership. So where I've been involved before, it's just kind of, I had a partnership credit card and all of my motor expenses just went on there. It was totaled up and I just kept a track of my mileage. And at the end of the year, I went, this year it's 22.5% of my mileage is business use. And that's the allowable part that went through the...
And you then owe money to the company?
No, it was just kind of, we took it as run of the mill. We will roughly spend about the same on our cars every year. Therefore, it all went through.
Okay.
So, but that's where the nuances come in, particularly with an LLP or a partnership, is your partnership agreement is you sit around the table and thrash out what's acceptable to you all.
Okay. That sounds like trouble ahead for me.
Yes and no. I think it depends on if you're going into business with people, you generally get on with them and know them, and you're not, there's bigger things to sort out than whether you're all going to run your motor expenses.
Oh, for sure. Yeah.
So it's kind of, some years it might be that actually, you know what, I've done 50% of my mileage has been business. Therefore, it's actually more acceptable for all of mine to go through because I've had a bigger proportion as work related. It's one of those swings and roundabouts things.
Okay, you win some, you lose some.
Yeah.
And I think if you all got the common goal of growing, and you should, in most businesses, you're making more money than you're taking, and it doesn't matter. That little bit of excess floating around at the top doesn't matter too much.
Okay, fair enough. On that subject, is that just the partners that have that? So staff don't have those benefits?
Staff generally is.
Would they be back to, if they got a company car, they'd be back to benefit in kind?
Yes, because they are then employees.
Fine.
Because when you're a limited company, you're the employee as a director, whereas as a partnership, you're a partner, so it cuts you out, but the employees are still employees.
What?
And you can't deploy yourself for an LLP if you're going down that route.
Well, I was going to sort of go, and I'm probably going off on a weird tangent here, but I know that as the business owner of visual PR, that I can occasionally have issues when I'm trying to go through finance applications of some description where I've got this self-employed, actually not, rather than director and owner, it's actually that I'm just deemed as self-employed, and that sort of has connotations to it. For the finance companies, what are you in an LLP?
Self-employed.
It is still self-employed.
So the whole that a lot of people call themselves self-employed when they got a limited company because they work for themselves, and because they're working for their own business and bits like that. And it just comes down to what people call that phrase. So technically, you're investor and an employee, but that doesn't tick the right box.
No, exactly.
So it's just making sure that what they ask the question when they say self-employed, which self-employed do you mean?
Oh, really?
Sometimes it is, yeah.
But if it's an online form, its computer says no. So
yeah,
it's complicated.
So there's a lot more that are saying you're a limited company, are you a director of your own company? Okay. And then it's tick that box, and then it opens up the next few doors. So again, I'm just doing a mortgage application, and it was used to be self-employed or employee and stuff. Whereas now they're just more understanding of the director of your own business.
Goes to show how long it is since I've applied for something. So that's a different subject for a different day.
Just one more little quirk on LLP versus limited company is if you're in a business that's going to do research and development, that you want to use the tax credits, you can claim research and development through a limited company, but you can't through an LLP. So it's just if you're in certain industries or sectors that you are R&D intensive, then again, that's a tick in the box for a limited company.
I mean, there opens a whole other another episode.
Absolutely.
We're hearing more. There's like companies that go out and help you to get your R&D credits or whatever, and then suddenly the government are coming after them, going, actually, you shouldn't have had that, and you've got to pay them back that money. So it's a woolly area that
it's becoming a bit of a minefield because we did go through a spell of everybody was chucking them in, and the government have now decided, actually, you know what, we've spent out far more than we were expecting to, and we've not really seen any productivity gains from all of this work. So we're now more thoroughly checking the claims.
I know I had someone come to me sort of going, no, it doesn't have to be an invention or something like that. It could be that you've got a new idea as a service. And it was like really the boundaries were coming down. And I'm like going, I don't like the sound of that. And they'd be successful, they'd get it for you, but then you get found out further down the line and you've got to pay that money back when you don't have it.
Yeah, when you've already spent it.
It's already gone.
Not a comfortable place to be in. Okay, so I mean, it really is quite interesting in a number of ways. We start getting a bit more specific now, and apologies if I took this in the wrong direction, but one of the other ones is that paying in dividends. Now, as an owner with a limited company, the whole dividend tax efficient way of paying was historically a really good way to go. But it's not quite, I think you were sort of suggesting to me, it's not quite always as clean cut as the best way to go.
So it depends as well what your salary package is. You could do a graph, and at different points the needle moves whether you should be taking it all as a salary. So as a limited company, you've got your salary as a director, or you've got dividends. So dividends are paid as post-tax profits. So you get your profit, take your corporation tax off. That's the amount that can be paid as dividends. Okay.
Yeah.
So if you haven't got any profit, you can't take any dividend, but you could take a salary, because the salary is a pre-tax cost, and you put it through. If you got the cash, you can put it through, right?
Yeah.
But the thing that's changing is, so when you take that money out across the line into your personal bank account as a salary or dividends, you then have personal tax. So what's happened is you've got corporation tax for a lot of businesses now are edging towards 25%, and it was 19%. So there's a lot more, even though the way the press was that it would be the big companies were earning above, but a lot of companies are now paying 25%. And then you got your personal tax on dividends. If it's in the basic rate band, it's 8.75. It used to be 7.5. But you also used to get 5,000 for free. Now you get 500 quid for free, right? So there's a little movement there. And then over the basic rate band. So when you've earned more than 50k, it's 33.75%. So a third goes, but after paying 25% tax in the company. So all of a sudden, if you're earning, and what used to be 50k used to be a good salary. If you heard back 5 years ago, someone earned 50k, you go, they're on really good money, well done, right? Whereas now there's a lot of places, like people I'm seeing earning 50k that can't even afford to pay for all the kids' stuff, right? With all families and all the things going on, with everything going on. So now you're going into above that, and they're paying that higher rate tax. More people, like everyday people. I know there's certain politicians have been slated for saying these salaries and different bits, but from what we see with a lot of clients and stuff, it is just covering costs and that, and they're paying higher rate tax. So it gets really expensive. So it's just understanding what is the best way of doing it. So the other way is going, right, actually, I'm not going to take any dividends. I'm going to put it through as a salary, and I'm going to put myself as a 50 or 60k salary through the business. Yeah. And it's trying to we do calculations all the time, working out what that salary package difference is, because in a company on a salary, the company pays national insurance.
Yep.
And if you're the only director, you don't get the thing called employment allowance, which is the first £5,000 of national insurance is free.
Okay.
So you need to have 2 or more directors or 1 employee earning over the threshold to get that. I think I got that right, isn't it? Yeah. I remember Liz telling me all these things. Nah. And then you also, as an individual receiving that salary, pays national insurance.
Yes.
Right. So although you might not have any corporation tax because your profits is low, because your salary reduces your profit down because you've got high expenses, you got all this national insurance charge. So quite often the needle moves one way or another of how much you've got in your back pocket.
Yep.
So we run calculations, like I say, calculations that do that back pocket check. If you took it as a salary and dividends, if you took it as just a salary, what the difference is. We also do it if you were a sole trader, what the tax would be then, just to see if the tax is the driver, which one puts the needle as the cheapest tax.
Yeah. Okay. And
still with us?
Yeah. And just to make something clear, although we've moved on from the LLP limited, because that was just one subject about the future of the limited company, is it different if you're an LLP with, you did touch on it?
Yeah, because the LLP has a taxable profit each year, and then the profits are allocated to each individual as per the partnership agreement.
So
and
it's
then
totally
they're taxed.
different grade.
Yeah, they're taxed effectively then as self-employed on a separate basis.
So to make it clear, Too late. Is that we have, so that was first the LLP, the limited. Now we're looking at the whole dividend tax. Now I can relate to this because when I first set up, it was like, right, great, you know, pay that much in terms of dividends. And then I got made a mistake over time where I thought it was about the cash in the bank. It's not. It's not about whether I can afford it physically in cash. It's actually got to be the right level of profits in it. Otherwise, it becomes a director's loan account starting to go up. That means that you owe money.
And that's the biggest trap with a limited company, is because you don't pay, for most businesses, you don't pay your tax till 9 months after the year end.
Yeah.
So at the point when you pay your tax, you've got 21 months.
Don't look at me. I don't know.
21 months of profits, right, in the bank. But but naturally, when you see money in the bank, you're like, oh, I'll have some of that.
Yeah.
Right. So if you're earning 50k, you got 10k tax bill or 12k tax bill. Right. That money sat in the bank at the end of the year. But naturally, you see that and go, I've earned that. I'll pocket that. But that's the risk. So that what we talked about before, your dividend being your profit after tax.
Yeah.
That's where you need to be aware of it. And so a lot of people end up taking, oh, I've got 10k, 12k in the bank. I'm going to take that out and spend it. And then we come along, if we haven't done the pre-year end checks, which is what we're we like to do, is to look at it 9 months through to make sure no one's fallen into this trap.
Yeah.
The last thing you want is us coming over 8 months going, oh, you've now got another way of saying naughty tax, S455 tax,
Naughty boy tax.
because you're taking too much money out, because it gets expensive. And
which is not, I mean, it sounds bad to say the naughty boy tax that we've had a joke about. It's like going, I wasn't doing anything underwards. It was like going, I was just paying money and it was being put in that column because it was allegedly the right way to go and the money was there. It was not an issue. But it's like, no, actually, you've now inflated a different.
It's that
bucket.
self-discipline thing of understanding that the limited company is its own separate legal entity. So the money generated belongs to the company. So we have lots of trades, particularly, who've gone from being subbies to having a limited company, but their mindset is still, it's my money because it's me. I'm doing everything. Therefore, it's my money. Well, actually, the reality is, I'm afraid, no, it's the company money. And that's the priority, is remembering that it's company money. You can't just, life gets in the way. So the wife, example, wants a new kitchen. There's money in the bank account, so it disappears.
Don't get any ideas, love.
But it's just general things that happen in life that you suddenly go, I need a chunk of money. My business has produced a load of cash. It's just sat there. So you go, okay, I'll have it, without remembering the link between, as Mike said, the profit, the tax element that the company has to pay, and you can have what's left.
You can still have the money, but it goes in a different pot that's taxed, i.e. salary.
That's it.
So
that's it. So a lot of people fell into the trap in lockdown. Their income disappeared. They took a bounce back loan to survive on. So they took the money out of the business to live, but not realizing they didn't have the income, therefore the profit. So there's a lot of businesses during that time that had this overdrawn loan account. But then the other way to do it is, this is where sort of one of the points we've got here is, for the startups, do you have a salary to start with? So a lot of businesses, so there's a high percentage of businesses who start up in the first 3 years don't actually make it. They run out of money, the business isn't successful, right? So then it generally has to, if you've got debts, it goes to an insolvency practitioner and they close it down, right? Which is fine. That's what their job is. They close that down. But what's happened is, if you've been taking out £2,000 a month, 1,000 of that is a salary, and 1,000 was your dividends, but you haven't made any profit after tax. You're building up this loan account, and then if it gets to the point where you go bust, you have to liquidate. There's a pot that shows that you owe the company this money. So the liquidators come in to settle up all the debts with all the people, and they could look at the director and go, you owe the company 24 grand. I want that money back. And you go, well, I paid the mortgage with that. I put food on the table for the family for that. And this is why we're really passionate about working with startups. When we're doing it, you have to talk with us. We have to keep an eye on profits, because if you're going to go down I'm going to pay less tax through the dividend route, you got to make sure you make the profits. Because if you don't, you could be walking into a trap where you haven't made enough money. And therefore, if you go bust, you have to put your hand back in your pocket to bail out the business that you've worked so blooming hard for that has just failed.
What should have happened in that situation? That somehow you try to survive on being paid less, or it gets redirected as a salary for £2,000. Use your figure. It was actually a £2,000 salary. not 1 and 1.
So the thing to do is salary's got to be submitted every month. So it's being aware of where you are, and it comes back to last month's episode of the business plan. What are you aiming to do? Where's your little bit of finance plan to see how much you're going to make, so that we can see in time, oh, we'll put you onto salary. Because we can't go, oh, actually, we're going to go back and we're going to change the last 12 months, 3 months later, we're going to change it to a salary, right? Because you're going to go back and redo all your submissions and change your salary. When you said it was 1,000, now it's 2,000, because I realised I'm in a bit of trouble. That doesn't go down very well if you then walk into the next meeting and say, I need my business shutting down. So the biggest thing out of all of it is you've got to be looking up. So for so many years, probably before I started in accounts, the big thing was looking backwards, looking what you've done. That's what we've done. Oh, lovely, great. I think nowadays the big thing, you've got to look forward with your business. Look up and look forward. That's why you've got cloud account software. It makes it easy. You can look forward. You do a little bit of a plan. You understand where you're going, so that we can work out whether it's a salary or dividend. You think of the ones that start, they know they're going to lose money. Okay, but you need to live on it, but you're gonna lose money. You've taken a loan. This is the investment. It's the plan. 3 years and you're out. Right, salary. Go on a salary at the start, because you're not going to make any money to start with. So therefore, you can't take any profit out. You haven't got any profit.
It's going to be more harmful than good.
Absolutely, and it also applies to businesses that are potentially cyclical, because if they go for a run, if they've got a couple of years, they're making profit, and then they know they're going to for example, projects come to an end or something, and they're going to have a couple of years without any profits. Salary is the best way to do, because all right, it's going to create a loss for those fallow years, but it's a tax loss that you can carry forward to offset against when you do start making profits.
Yes.
Whereas if you're going for a dividend route and you've got no income coming in, so you're not generating profits, you have got no earnings in that period.
For people that might be watching, and I probably do still include myself in this. I know that we've had this conversation numerous times, but we're busy. I'm trying to run the business. I'm trying to do 1,000,001 things within it. For me to sort of like understand, okay, I can't forecast, turn around and go, although I think visual PR is probably slightly different beast because it's retainer business, but I can't necessarily turn around and go, I know I'm going to be earning this from it, and I'm going to keep my expenses down to this, etc., with extreme accuracy, at least anyway. And I'm sure I'm not unusual on that. So for me to kind of weigh up, should I be salary, should I be dividends, is that a conversation that us business owners can have with you guys at Optimum?
Absolutely. For me, it's always that the starting point is, what do you need to live on? What do you need to withdraw from your business? And then we're working backwards, working back up effectively up the P&L, going, right, okay, then what are going to be your overheads for running your business? Then what are your direct costs? Okay, you need to generate this kind of income. Yeah. Is that going to work for you? And if it is, then yes, we can go, right, okay, right, we suggest you do this down this route. And then, okay, a year later, the business is growing, then you can change your approach. Because again, we'll sit there and go, right, okay, you're doing nicely. Do what you need to spend on a monthly basis. Has that gone up? Yep, okay, right. So we reforecast and go, right, okay, the turnover you're needing now is going to be at least this. Do you look as though you're growing to that level? Yes, great, fine. We can carry on with this plan. If not, then yeah, we'll just do an adjustment for you.
Okay. Yeah, we need to sit down.
I think it's as a business owner, you tend to have a mentality of you know that you're the one who's putting food on the table. So you're not an employee just knowing that you're getting a wage check at the end of the month or the end of the week. So you know what you need to earn. So that what Rob said, you start, what is it the minimum amount you need to earn? That equates to 2 or 3 grand a month as turnover in the business, right? Yes, you might not know where it's all coming from, but if you know that you have to earn it, you go and earn it.
Yeah.
It could be all on the first job that you do, or it might be spread across. You might go and get 10 jobs to be able to make it work. But as a self-employed person, you know that that's what the responsibility is to do. So I think that's the big thing, is that yes, you might not know where it's coming from, but once you know that you could sell so many different packages for yourself, or like we could sell so many different accounts, we know where it's going to come from, or we know what we have to do. And if there's a shortfall, then we know you've got to go out and sell some more.
Sure.
Because you can't just sit there going, oh, no one's coming through. You have to go and do it. We've all gone through cycles where we go, oh, hang on a minute. No, we have to go and push it a little bit harder. So you get out there and you see it with any business. They go, oh, yeah, no, I have to go and sell. I've got to go do this. There's very few that it just keeps coming through the door.
It's if you're sitting there going, right, okay, I'm working back up. It's that, right, this is the monetary value of what I need to bring into my business. So you've got your target that you know what you would do. And the next stage is then just breaking it down into whatever you do. So do I need 3 retainers a month? Does that equate then to it? Or is it, I've got to sell so many thousand pints this month because that's what I need to get through to generate my level of turnover?
Which actually is it probably is a lot better that way. I mean, I've always done, not always done, but as in my mind, if I'm being too sidetracked by actually working in the business rather than on it, is that it will be a cash flow equation that goes, right, what do I need to do to pay for everything and da da da. Whereas actually it goes deeper than that, is that we need to do it. But it's not as complicated as the brain starts panicking with, is literally by doing the backwards equation. And it is okay to turn around and say, yes, I need this to live off of.
Yep.
Right, what does that mean I need to do? And then you've got these targets that goes, right, I need to get another X retainers or sell X number a month or whatever it is. And like you say, that we roll our sleeves up and off we go and we get on with it.
There's an episode we've done near the start. I think it was me and Hannah where we did this the scenario where we worked from the bottom upwards.
Yeah.
Go, right, what's the personal earnings? That's the corporation tax. What's your overheads? That's pretty fixed. Therefore, that's your sales target. And what happens if you want to do this and do that? Do you remember that one?
I do. And in fact, even going to last month's episode again is about not just the business plan, but the revisiting the business plan regularly, is that it suddenly switches me to that goes, that needs to be revisited. In fact, that could be the catalyst for what today's business plan is.
And that you're keen with that is always going over with the personal service. What is it you want? What's changed? What does it need to do?
Which is external forces as well. We know that the cost of living and all that sort of stuff.
Yeah.
We get it. It makes sense.
But it's about that top line figure. Don't be intimidated by it, because you come out and you go, right, oh no, I've got to earn $250,000 this year. Break it then down into what you do. Break it down into small chunks. Don't frighten yourself with a big figure. It's about going, right, okay, it means I need to get 5 retainers a month and a couple of projects.
And then everything over that is happy days.
Is the cream.
What would we do with that? Now I'm getting excited about that over that figure. Does that become more dividends that can be paid, or does it stay invested in the company?
Whatever you want, whatever's in your business plan for your growth. It might be that you go, the business doesn't need any more stuff. So actually, I'm going to put the surplus as a pension contribution because that would be nice. Save tax for the future, or it might be, no, it's about time I add a little bit more because I want some more holidays.
So it could be,
or the wife wants that kitchen,
or it could be a growth of premises. It could be more people get employed. It gives.
So every business is going to be different depending on what it is. It might be that you've had a few fallow years and you want it. I like that. And you want to earn a bit more because the last 2 years have been quiet. You've invested yourself into the business by not taking the money. And now you've earned it, you want to take it back what you didn't take in the years before.
It makes sense.
Again, it comes to your longer term plan. What are you doing with your business? Again, is it, I really want to invest it and grow it, in which case you potentially leave a lot more behind in the business for that investment. It might be there's nothing immediately springing to mind, but my long term plan is 3 years' time, I want to invest in, I don't know, another 3 staff, or actually, I want to acquire a competitor. So I need a bit of cash sat in my business in order to be able to do that.
Or not even a competitor, is that you want to absorb something that helps you diversify or bring some of the services in house. Yeah, absolutely. I get all of those things, and I mean, crikey, I think we came up with another episode, whether you realise it or not, yesterday when you touched into SIPs and and things like that, and I was like, oh wow, I hadn't thought about that stuff, but we'll come on to that another time. Quickly, Adam, you mentioned Hannah, and I think this is really, obviously she's within, but she's going to be putting a question that she has posed to her, and she says, do dividends provide more flexibility, and how would my year end have an impact on this versus a sole trader or an LLP? Well, we maybe have covered that already in the comments.
So, like a sole trader, you're doing your tax to the 5th of April, personal tax, which you still do as a director of a limited company. But if your limited company year end is, say, 30th of April, 31st of May, it allows within that set of financial statements to a bit of flexibility as to when you declare dividends, as to when's best to put them on your personal tax return.
Got you.
So again, you got the planning opportunities to do. So we can work so that if you go, right, 1 year, I want to take out 150 grand to put on a new, to buy the next house. If you did it all in 1 year, then it'd be expensive. But if we do the planning for you, might be able to spread that across a few years. So you keep low rate. So again, I had someone who he was making some good money, taking very little out of the business. But I was like, I'm going to keep topping you up because at some point you're going to go, oh, I want the money out of the business. And 3 years later, they went, oh, we're doing the extension on the back of the house. I need 200 grand. I said, well, if we hadn't done this planning, that would cost you, well, I don't know, 80 grand in tax. I said, but because we've been doing it, you've been paying 5 grand a year in tax. And that's it. And save it. And it was for them. It was I understand now why you're doing it. Because as much as we tried it, they didn't. They trusted that we were doing the right thing for them. And that's what's worked. So yeah,
that it was for them. I mean, and we've had conversations about people that might be a property goal. I think we had a retirement-based goal. That all these different things that some of your different clients have had the experience, and it means we get to do that. And Hannah's just said she was hoping that was going to stay anonymous. Sorry, Hannah. It does, but we understand why you've done it. We're trying to trick the guys up, but no, we get it. We get it. Kev Barker's put another one. What is the tipping point for tax changes to switch to an LLP?
Yeah, it's going to be dependent on quite a few different. I'm going to sit on the fence. It will depend on a lot of things,
mate.
Whether it's again, how much they want personally out, how much if they're putting a car through, how much pensions, and it would just run as calculations per scenario. There used to be the old, like we used to have like an unwritten rule that if you weren't over 30k, you go into a limited company. Actually now there's so many other factors that are driving it that figure, if you went on the tax one, could be a bit higher, but it might not be. And so we just run each scenario.
It's one of those that you don't want the tax tail to wag the dog.
Yes.
Because actually, I don't know, if we had time to go on to associated companies, etc. The reality is, all right, it might be a tax impact for doing it a certain way, but actually the other benefits around operating in that kind of vehicle means that actually overall you just suck up that extra little bit of tax because the other benefits that you've got. So again, like if your longer term plan is you want to build a business and sell it, even though you may pay a bit more tax personally through operating a limited company, it allows you to much stronger opportunity to sell your business at the end of it than if you're operating through an LLP. So tax is only one kind of spoke on the wheel that you've got to sit there and go, right, okay, in the middle is my entity, what's it going to be? And there are lots of spokes of different parts of your life. The tax is one of them. And so it shouldn't necessarily be the whole main driver.
Company cars is a prime example. So we'll say electric cars are great for a limited company because they're great for tax. Yeah. But if you need to drive 400 miles in a day, like tax wise, it's great. Practicality, it's not. No. Exactly. So it's looking at the big picture.
Kev's follow-up comment was changes to dividend tax. So I'm not sure whether that took it in a different direction.
So it's going to depend whether the new Parliament are going to change it. At the moment, it still works. It's still right. I think I did a calculation. If you were taking about 140 grand out, that actually a salary was worked out quite nicely at that point rather than there. But it's where you want the liability of tax and stuff, because if you're earning big money and you could have the liability being paid by the company and you just take your money out as a salary, you have to think no more about it. Yeah. Great. Whereas if dividends, you're building up a tax bill personally, and if you don't remember about that, you personally could run into the tax cost rather than it being in the company. So there's another one.
But it's about your whole overall package.
Yeah.
So you need to remember that you don't necessarily need to take all of the profits out as dividends or a salary, because as we discussed earlier, there's company pension contributions and all sorts. So it's about actually what are my personal longer term plans? Do I need it all out as cash, or actually can we do things with it?
Yeah, agreed. Kev also said if they fall in line with income tax.
Dividends do. Yeah, so they're on income tax. Profits or a profit share that come into income tax. Yeah.
Got you. Okay. Thanks, Kev. Keep them coming. That's really good. I do want to move on to a point that you did touch on. I'm not sure how much, we haven't got time to go into great detail of it, but I came unstuck on this one. Associated companies. Now, let me make this clear with an example that's frustrated the heck out of me. Last March, I have a company called Open Doors Training where I do public speaking training. I'm a motorsports commentator, a voiceover artist, all those things, and that goes through that. I then created Visual PR Limited, but left it dormant. This was last March, left it dormant with the intention to put it all through, because there's no point having all these extra fees for two companies when it was trying to get off the ground. I could trade it through Open Doors as a trading name with the intention that as soon as I got enough contracts, it would flick over to Visual PR Limited. I was all ready to do that, the tail end of last calendar year, and you just suddenly went, don't. Because in April, they brought out this associated companies thing that would have suddenly split the corporation tax threshold before the higher rate. Instead of 50 grand, it would have been 25 grand on both. Why?
It's essentially to stop people doing it that,
but
as a tax motive rather than a commercial motive.
It impact? I mean, that's a negative impact, and there's a lot of people that were interested on this subject in particular because they weren't aware of this, as I wasn't when. Well, it didn't exist when I first did the dormant ready to go to protect the name ready to go. It's impacting entrepreneurs. That was a new idea. It was a new company that was legitimately going to be its own entity that was going to be going off in a different direction to the other stuff. And I've then gone, no, because of these people that are doing this, like especially in the property game, for example, and button up to the morning, starting a new one, because of them, I now get hit because despite me having a good idea.
And this time round, where you've got the split tax rate between 19 and 25, there's a lot more rules and regs than there was when it was previously in. With this marginal rate. So essentially the short answer of this is if you've got more than one business, you're going to pay 25% tax a lot quicker than you were.
Yeah.
Even if one's not making any money. So it's straight on that. And with associated companies, it is just making you pay that higher rate of tax a lot quicker. And I don't think a lot of people realise quite what comes under the associated rules is spouse's business. It's all, they're connected through
within reason. I hear on the spouses, because I said, so my wife is a physio by trade, and she works in the NHS, and she then decides she's going to go and have a private physio practice, and I'm nothing to do with it, it's hers. She wouldn't suddenly have the hit on the split over with that, would she?
It's not straightforward.
Oh,
yeah, it's kind of
because that just doesn't seem fair.
It's the minimum controlling combination is kind of the wording that they use. So
I'd sack her as a director then. Is that
no, it's not the director though. It's because it's the shareholder.
Remove her shares then.
Yeah, it's they have to broaden that definition, because I think, as Mike said, it's kind of to try and stop people just keep popping up businesses. But also it's putting them in names of people that probably weren't doing it. Right. So they, like family members, they chuck it in, they're the owners, and it's a form of removing the tax. So that's why they're trying to tighten up to try and bring it back in. But again, it comes back to...
It doesn't feel quite right. It doesn't sit with me that I came up with another idea and I suddenly get hit.
No, absolutely. It does have a downside. And I think the thresholds are quite low that they hadn't really taken into account, bearing in mind that something like 95% of the registered companies are small, so are going to be down that bottom end. The whole idea was to try and penalise profitable companies that aren't paying tax. With a high, absolutely. And it's kind of, unfortunately, the bands are probably sat too low, but actually the $250,000 was probably actually the right level to hit it at. So you're targeting properly profitable companies that are doing it. So it's not pleasant, and it's something to be aware of. And if you do have a multitude of companies, it's one of those sit down and have a conversation about who controls what. Right, okay. Because there's also things like about commercial interdependence. So, for example, if you've got a company that's owned by different people, but it relies on this company for finance and that kind of stuff, potentially it will be caught. So some things that you might not think are at all associated by these expanded rules probably will.
Right.
But it's also, don't let it, again, as I say, don't let the tax tail wag the dog, because actually for what you do, it might be right that you have a number of companies and you just have to accept for the time being that it's going to be one of those costs to you of structuring your business environment in the way that's going to suit your long-term plan. For example, property construction companies quite often would have a construction company and then potentially some SPVs where they do special projects through, but also then maybe an investment company that they hold property that they've, for example, you build a site of 10 houses, you might keep one and use that as a passive source of income for the group. That means you've got 3 companies that are going to get challenged into this new structure, but actually structuring it like that is absolutely right for your business intentions.
Yeah. And I guess am I right in assuming, because what was it? It was, so if I've got one company, I've got £50,000 worth of profit before I go up to the next level of corporation tax percentage.
Yeah.
If both of my companies, so I've now got 2, and by the way, that 50 grand gets shared between 2, 3, 4, depending on how many you've got, so it suddenly gets lower and lower. But if both of my companies are above 50 grand profit each anyway, it doesn't matter. It makes no difference.
No.
It's only if both of them happen to be, let's say, sat down at 20 grand profit. No, I'm trying to work out at 30 grand profit.
Yeah.
That suddenly I'm going to get a much bigger corporation tax because that's now actually 60 grand. So I'm up into the higher rate for both.
Because you're above the 25. If you've got 2 earning 50 and you've got 2 companies, instead of your rate going up at 50, essentially, to be a higher rate, your rate's going up at 25.
So you are still.
So you're having half of it is. So it still affects you.
It does, yeah.
It still catches you out.
I guess we should be used to it because in school it always used to be the majority suffer because the minority, and in society is.
I think it's remembering now in business you've got, if it's 2 of you, you've got a third party, a third stakeholder in the business. You don't own all of it. You've got HMRC that have got a stake in it as well. They take theirs out first before you get your dividends. It's just like having having an ex-partner there.
On that note, 2 quick, because I mean that was really useful. I mean, in essence, what we're saying, just to sort of wrap up that associated companies bit, is to be aware of it. Is that if you've got more than one company, is that the threshold gets split between them. Speak to you guys or whoever their financial advisors happen to be, or whatever. Is that there's a consideration that needs to be. Does that automatically get applied? So, I might have inadvertently gone, no, it's fine. I've known about that associated companies, but suddenly automatically HMRC would work.
No, we because it's self-assessment tax, corporation tax, self-assessment, so we have to do it.
So guys.
So then, if you get it wrong, and then HMRC spot that it's been wrong, then you've got to collect the underpaid tax and potentially a penalty of carelessness on your tax return.
Right. Okay. Fine. So that's important.
So you can't play naive.
No, don't do that.
Just will hold up. Yeah.
So it's one of those areas now. It's kind of, in the past, people have had, if they've had a multitude of companies, quite often the batch would be one advisor, batch would be with another. It's now actually clients need to be completely open with the advisor because we need to sit down and be able to assess it in full.
It's the only way you can give the full advice and the true advice. Absolutely,
yeah.
And it's one of those awkward ones, is that we know the situation for me is that what it then meant, because Visual PR is just over a year old and is growing rapidly and is going to be the bigger organization. The other stuff is my media work and is a lot of fun and is a lifestyle business more than anything. The public speaking kind of funded that lifestyle business, if you will. Still going, but personally it's a bit more reactive than proactive. It is what it is, and it's still going nicely. But I felt that Visual PR was more important. But whilst fine, I couldn't get that one out without taking this hit on the corporation, is that we did a name change. The bank were confused to hell with why I was doing that. Whereas actually it's like, no, it's legitimate. The irony is, I even explained to the bank, this is the reason why the Associated Companies Act, and they went, no, what?
Yeah.
They had no idea. And so they just suddenly were checking that I wasn't doing something questionable. And so that had to be managed in a patient manner as well.
Yep.
So interesting stuff. Right. Payments on account, including reducing. That's the only note I have.
I'm going to say, I've got, for time, there's a blog that we just put up on our website that explains what payment counts are, when they're due, why they're due, and no, you're not paying tax in advance of earning it, which what everyone seems to say when we go, you got your 6 monthly payment, why am I paying it ahead? You're still behind, but you're just not behind as far as you were before. But there is a blog on that one that spells it out quite nicely.
I think we did touch on it in one of the other episodes to some extent as well. Possibly the very first one when you came into my office.
Yeah, it could have been. That was fun. Yeah, I don't know, one of those. Yeah,
something like that. Because we were talking about the VAT, the threshold, and when it works out and all that sort of stuff.
It's just obviously 31st of July is the
Yeah,
payment date. So
oh yes, of course. We're now past that 1st of
Yeah.
July. Yes, it is important. Getting a full state pension.
Full state pension is important, very important. But so to get it, depending on how you are, so if you're self-employed, LLP, partnership, sole trader, you register as self-employed and you were paying the class 2 national insurance, which worked out about £160 a year.
Yeah.
That has it been scrapped yet? Going to be scrapped? Talking
was-
about being scrapped?
Yeah.
Yeah. So it will depend on how much you're earning now to whether you get your stamp. When you're a limited company, you get your stamp through your salary. That's why you hear people with a small salary, big dividends, because the salary goes on the payroll, gets submitted to HMRC, and if it's more than six and a half grand a year, then that is what gets charged. That's what gets you a registered stamp for state pension. But the most important thing is everybody can log on to and set up a personal tax account with HMRC. You log on, you set it up, and you can see your state pension record.
To do that.
You should go and do it, Chris.
I do.
Told you
Yeah,
to do it.
absolutely.
Because the sooner you, sorry,
I
go
was
on.
just going to say it gives you that full record, and it'll tell you for missing years. And there are certain timescales that allows you to do a top up
Okay.
because you need 35 years to get your full state pension. And whilst that may not be worth a huge amount, if you're working for 35 plus years, make sure you've got that.
Get what you deserve. So what do I need to do to see these
So
missing years?
if you go to HMRC and put personal tax account in, you register with that. You need your passport.
Well, I already have one of those though.
Not always, no.
If you set yourself up for a government gateway,
Yes,
I think I have
perspective, then yes.
but as an individual, not.
But
a
I don't
company.
remember. Well, this is where I've got a trouble. Is that I don't remember that.
So
login.
if you haven't used
my web browser defaults to the company login, and I'm like, okay, I can't remember.
So if you haven't used it for a couple of years, they automatically cut the access, so you set up a new one anyway. But if you go through and set it up, it will go, you've got another account, or it will just allow you to set up a new one with your passport and stuff. And then you go in there and there's a few national insurance record, and in there it's got whether you've got gaps. And the important thing is there's a lot of people where we've picked up businesses over the years, they thought they were getting their stamp for state pension through their limited company, and they didn't. But what happened is we spotted them, put them on a salary, got that all registered, but they've got gaps for quite a few years. But if you're looking at it, you're aware of it, and it's a lot sooner to fix when you're 35, 40, to make sure that you're getting the right stamps, rather than it is that you're 64 just working out how much of a state pension you got, and you realise you've only got 10 years because you've got too many gaps all the way through because you didn't realise. Okay. So the sooner you do it, just to check, it just saves a lot of aggro. And if you're working with your financial advisor, it's one of the first things they do on their checks is to go get that printout so they can check that it's working, because that's part of their planning for your
HMRC, personal tax account, and then view national insurance records.
Yep.
Fine. I'm going to go and do that. That's got an asterisk there. I'm going to go and do that. It's come up in conversation before, and I've still not gone and done it. Good old Kev's got another comment. Well done, mate. Appreciate all your questions. It's brilliant. Could you make your limited company a partner of your LLP, and is there a use case for doing that?
You can. Again, it's something that's not overly popular with HMRC. So you can, but it's about making sure you manage it correctly, because it's about, not necessarily avoiding paying tax on profits by shifting them in the wrong way. It's got to be a genuine commercial reason as to why. Why that's
if you've done something and you get quizzed from the outside, why did you do it? And if it's for tax,
that's
then
the wrong answer.
it tends to be that it's not the right thing to do.
Yeah, because I mean, I was even trying to work out with the associated companies thing. Is like going, okay, but could I have a second company? But the owner of that is not me or my wife, but it's actually this other company. And it's like, no, because you're still linked to that. So you're still the thread's still there.
Yeah, the phrase they use is beneficial owners. So you kind of keep looking through the layers to find out.
Yeah, makes sense. It makes sense. Anything else that you want to cover in all of this?
Nope. No. Hopefully there's still some viewers.
There is. I mean, it's been absolutely brilliant. I hope that was not too heavy for you all. I mean, it was necessary to go into this. It's really enlightening. Some parts that confuse me and know that there's a conversation to be had. Some parts that have made sense and made me kind of go, I need to go and look at that even for myself. In essence, the great reassurance is there are people like you guys that are able to be there for us. We're running businesses, we're busy, we're trying to do everything else, and we could miss something. We don't understand, and we think that this means that, when actually it's a bit more than that. We touched on LLP or limited. What's your final comment on that? It's that if someone is thinking something to come and speak to you about that LLP or limited, what could they be thinking?
They should just be having conversations with us. If they're thinking of changing the business, or they're changing where they're going, whether that's the old business plan, changing direction or something like that, just have a conversation with us, because it's better to get in front of a tax change or a tax problem than it is going, we've already done it. What happens now? Well, you've got a tax bill.
And we've had the title "The Future of the Limited Company." This is being addressed now in this conversational piece, because changes that have happened and may yet be even more happening are making this an even more interesting conversation. That it's not as black and white or as obvious as it was before.
No, absolutely. It's about everything that's happening is getting people to think more and more about what they want to do in the future. It's that taking the steps, going 3, 5, end of my working life. What am I thinking I want to do?
Yeah.
It's trying to set yourself some targets along the way. And it's a lot easier for us to go, right, okay, that's what your aim and goal is. Right, okay, now what's the tax implications doing each way? Are they enough to override the principles, everything else that sits on that wheel that we talked about?
Yeah.
Or not?
You're able to see the picture and go, actually, do you know what? This lends itself more to LLP than limited, or vice versa, or whatever.
And there'll be no client that's got the same characteristics, because their personal life that drives the business, that drives the rest of it, is all different. So the needle moves every time.
I think that's the big thing that's jumped out of me for this, is that the future of the limited company is still there. 100%, it's still there. However, things have changed, things have got closer, things have merged, things of whatever. That means, actually, do you know what? There could be a deeper conversation that's worth having with the likes of Optimum to sort of have a look at it again. And don't. One thing for me as an owner that I keep reminding myself to take confidence from is that, despite being involved in this conversation with you guys, I don't need to sit here and be that expert.
No.
That's why you are there. But I now know that there's a conversation that I maybe wouldn't have considered having that might be worth just investigating. Yep. Simple as that.
Yeah,
100%.
Fabulous. Simple as that. Easy as that. Easy as that. Listen, thank you so much for watching, everybody. I hope that you found that useful. Hope you found it enjoyable. We'll be back next month. We do have a date for next month's show, 7th of August. Which is another Wednesday, and I think you're on that one as well, as long as we stick to the same topic. There's a possibility we might change it to an post-election one if we feel that
if they were doing a budget, but I think they're all going on their summer holidays soon.
So that will be delayed, because in essence it wasn't worth doing a budget an election one just because elections happened. We would need to be addressing
The budget
and things that are changing, things to be aware of, and we now know it is a changed government, so we need to let it evolve, don't we, before we discuss it. So, as we believe, 7th of August with yourself, and Ian as well,
Ian, yep.
And one of
my clients.
that's been with you for 15 years, is it?
Around that now, yeah.
I'm looking forward to that one. So get yourself strapped in for that one. It's going to be really good. And from Cheltenham as well.
From Cheltenham, yeah.
We'll be in the Cheltenham office for that one. But keep your eyes peeled. 7th of August. If you've got any ideas that you would like for show content, things that would be beneficial for us to discuss like this in more content, and maybe it involves you involved in the show, please drop us a line. Let us know, because these are monthly episodes that are there to sort of like really hopefully give you advice. Not advice. I'm not supposed to use that word, am I? Give you knowledge, give you information to make informed decisions. You can take the mickey out of me because I grow every episode. I've got to do that. It's really, really useful. But gents, thank you so much for joining us. It's been an absolute pleasure. And thank you to all of you. We'll see you on episode 10. We'll be up into double figures. Cheers all.